A balance sheet is a fundamental financial statement that provides a snapshot of an entity's financial position at a specific point in time. It is structured around the basic accounting equation: assets equals liabilities plus equity. One of the most important aspects of preparing and interpreting a balance sheet is the classification of its components into current and non-current categories. This classification is not merely a matter of presentation. It has profound implications for how stakeholders assess a company's liquidity, solvency, and overall financial health. Understanding the principles and rationale behind the classification of assets and liabilities into current and non-current is essential for anyone involved in financial analysis, accounting, or business management. At its core, the distinction between current and non-current items on the balance sheet revolves around time, specifically the operating cycle of the business and the expected timing of cash flows. The operating cycle is generally defined as the average period of time between the acquisition of inventory and the collection of cash from customers. In most cases, a period of 12 months is used as a benchmark for this classification, unless the entity's operating cycle is clearly identifiable and longer than a year. Current assets are those economic resources that are expected to be realized in cash, sold, or consumed within the entity's normal operating cycle, or within 12 months after the reporting period, whichever is longer. The primary purpose of current assets is to support day-to-day operational needs and provide liquidity to meet short-term obligations. Typical examples of current assets include cash and cash equivalents, marketable securities, trade receivables, inventory, prepaid expenses, and other assets that are expected to be converted into cash or used up within a year. Cash and cash equivalents, such as bank balances and highly liquid investments with original maturities of 3 months or less, are the most liquid form of current assets. Trade receivables arise from credit sales and represent amounts owed by customers, which are expected to be collected in the near term. Inventories, comprising raw materials, work in progress, and finished goods, are held for sale in the ordinary course of business or for use in production. Prepaid expenses, such as insurance or rent paid in advance, are recognized as current assets because they will be consumed within a year. Non-current assets, on the other hand, are those resources that the entity expects to hold for more than 1 year or beyond the normal operating cycle. These assets are intended to provide economic benefits over a longer period and are not primarily held for resale in the short term. Non-current assets include property, plant, and equipment, PPE, intangible assets, long-term investments, deferred tax assets, and other assets whose realization or consumption is not expected within 12 months. PPE includes tangible items such as land, buildings, machinery, and vehicles, which are used in the production or supply of goods and services and have useful lives extending beyond 1 year. Intangible assets, such as patents, trademarks, copyrights, and goodwill, are non-physical resources that confer long-term benefits. Long-term investments may include equity or debt securities intended to be held for more than 1 year, as well as investments in subsidiaries, associates, or joint ventures. Deferred tax assets arise from temporary differences between accounting and tax treatment of certain items and are expected to be realized over several periods. The classification of liabilities follows a similar logic. Current liabilities are obligations that the entity expects to settle within its normal operating cycle, or within 12 months after the reporting period, whichever is longer. These liabilities require the use of current assets, or the creation of other current liabilities for their settlement. Common examples of current liabilities include trade payables, short-term borrowings, accrued expenses, current portions of long-term debt, and taxes payable. Trade payables represent amounts owed to suppliers for goods or services purchased on credit, usually due within a few weeks or months. Short-term borrowings, such as bank overdrafts or lines of credit, are expected to be repaid within a year. Accrued expenses are liabilities for goods or services that have been received but not yet paid for at the balance sheet date. The current portion of long-term debt refers to the amount of principal that must be repaid within the next 12 months, even if the original maturity of the loan extends beyond 1 year. Taxes payable include income taxes and other taxes that are due within the coming year. Non-current liabilities, in contrast, are obligations that are not expected to be settled within the next 12 months or the entity's operating cycle. These include long-term borrowings, bonds payable, lease liabilities, deferred tax liabilities, and provisions for obligations that are not due in the near term. Long-term borrowings may consist of bank loans, debentures, or other forms of debt financing with maturities extending beyond 1 year. Bonds payable are a common form of long-term debt issued to raise capital, typically repayable over several years. Lease liabilities arise from long-term lease contracts, where the present value of future lease payments is recognized as a liability. Deferred tax liabilities result from temporary differences that will lead to taxable amounts in future periods. Provisions are recognized for obligations such as warranties, legal claims, or environmental remediation that are not expected to be settled within the short term. The rationale for distinguishing between current and non-current items is rooted in the need to provide meaningful information to users of financial statements. Investors, creditors, regulators, and management rely on the classification to assess the entity's liquidity, the ability to meet short-term obligations, and solvency, the capacity to meet long-term commitments. By segregating assets and liabilities based on their expected realization or settlement period, the balance sheet enables users to evaluate how well the company can convert its resources into cash and whether it has sufficient liquid assets to cover its immediate liabilities. For example, the current ratio, calculated as current assets divided by current liabilities, is a widely used measure of liquidity. A ratio above 1 indicates that the company has more current assets than current liabilities, suggesting a comfortable liquidity position. Conversely, a low current ratio may signal potential liquidity challenges. In addition to providing insights into liquidity, the classification also aids in assessing the company's capital structure and financial stability. Non-current assets and liabilities reflect the long-term investments and funding sources of the business. A significant proportion of non-current assets may indicate substantial investment in fixed assets, which could be essential for the company's operations and growth prospects. Similarly, a high level of non-current liabilities may signal reliance on long-term debt financing, which could impact the company's risk profile and interest coverage ratios. The balance between current and non-current items is therefore crucial for understanding both the short-term and long-term financial health of the entity. The process of classifying assets and liabilities as current or non-current is governed by accounting standards, such as International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP. These standards provide detailed guidance on the criteria for classification and require entities to disclose their policies and judgments in this regard. Under IFRS, for instance, IAS 1 presentation of financial statements stipulates that an asset should be classified as current if it is expected to be realized, sold, or consumed in the normal operating cycle, held primarily for trading, expected to be realized within 12 months, or is cash or a cash equivalent. All other assets are classified as non-current. Similarly, a liability is current if it is expected to be settled in the normal operating cycle, held primarily for trading, due to be settled within 12 months, or if the entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period. Despite the apparent simplicity of the classification criteria, there are often complex situations that require careful judgment. For example, some assets and liabilities may have components that straddle the current and non-current boundary. Consider a long-term loan with scheduled repayments over several years. The portion of the loan principal due within the next 12 months is classified as a current liability, while the remainder is non-current. Similarly, deferred revenue, a liability representing cash received in advance for goods or services to be delivered in the future, may need to be split between current and non-current portions based on the expected timing of delivery. Another area requiring judgment is the determination of the operating cycle. While a 12-month period is commonly used, certain industries, such as construction or shipbuilding, may have operating cycles that extend beyond a year. In such cases, assets and liabilities related to the operating cycle are classified as current, even if their realization or settlement is expected to occur after 12 months. This flexibility ensures that the classification reflects the true nature of the business and provides relevant information to users. There are also special considerations for certain types of assets and liabilities. For example, investments in subsidiaries, associates, or joint ventures are typically classified as non-current, given their strategic, long-term nature. However, if the entity intends to dispose of such an investment within 12 months, it may be reclassified as a current asset under the requirements for assets held for sale. Similarly, provisions for employee benefits may need to be split between current and non-current components based on the expected timing of payment. The classification of deferred tax assets and liabilities is another area that demands careful attention. Deferred tax balances arise from temporary differences between the carrying amounts of assets and liabilities for financial reporting purposes and their tax bases. The classification as current or non-current depends on the underlying asset or liability to which the deferred tax relates. If the temporary difference is expected to reverse within 12 months, the deferred tax is classified as current. Otherwise, it is non-current. From a practical perspective, the classification of balance sheet items has significant implications for financial management and decision-making. Management must ensure that sufficient current assets are maintained to meet upcoming obligations and avoid liquidity crises. This may involve managing cash flows, optimizing inventory levels, and monitoring receivables collections. At the same time, investments in non-current assets must be carefully planned to support long-term growth without overextending the company's financial resources. Similarly, the mix of current and non-current liabilities affects the company's risk profile and cost of capital. Short-term borrowings may offer flexibility but can expose the company to refinancing risk, while long-term debt provides stability but may entail higher interest costs. For external stakeholders, the classification of current and non-current items influences a range of financial ratios and metrics used in analysis and valuation. Liquidity ratios, such as the current ratio and quick ratio, focus on the relationship between current assets and current liabilities. Solvency ratios, such as the debt-to-equity ratio and the long-term debt-to-total capitalization ratio, consider the proportion of long-term obligations in the capital structure. These ratios help investors and creditors assess the company's ability to withstand financial shocks and honor its commitments. Moreover, the classification of assets and liabilities can impact compliance with debt covenants and regulatory requirements. Lenders often impose covenants that require the maintenance of certain liquidity or leverage ratios, which are directly affected by the amounts reported as current or non-current. Regulators may also set minimum capital or liquidity requirements based on balance sheet classifications, particularly for financial institutions. In summary, the classification of assets and liabilities into current and non-current categories is a foundational aspect of balance sheet preparation and financial analysis. It provides critical information about the timing of cash flows, the company's liquidity position, and its long-term solvency. The distinction is guided by accounting standards and requires careful consideration of the entity's operating cycle, the nature of its assets and liabilities, and management's intentions regarding realization or settlement. Proper classification supports effective financial management, facilitates meaningful analysis by external stakeholders, and ensures compliance with contractual and regulatory obligations. As businesses evolve and financial instruments become more complex, the importance of sound judgment and transparent disclosure in balance sheet classification continues to grow. Companies must regularly review their classification policies and update them in response to changes in business activities, accounting standards, or economic conditions. Auditors play a key role in evaluating the appropriateness of classifications and ensuring that financial statements present a true and fair view of the entity's financial position. Ultimately, the balance sheet serves as a bridge between the past and the future, capturing the results of prior transactions and providing a foundation for planning and decision-making. The classification of assets and liabilities as current or non-current is central to this function, enabling users to assess not only where the company stands today, but also how it is positioned to navigate the challenges and opportunities ahead. By understanding the principles and practices of balance sheet classification, stakeholders can make more informed judgments, manage risks more effectively, and contribute to the long-term success of the organization. The ongoing relevance of current and non-current classification is underscored by its adaptability to different industries, business models, and economic environments. While the underlying principles remain consistent, the specific application may vary depending on the nature of the entity's operations and the characteristics of its assets and liabilities. For example, a manufacturing company may have significant investments in plant and equipment, with inventories and receivables forming a large part of its current assets. In contrast, a technology firm may have substantial intangible assets, such as intellectual property and relatively low levels of inventory. Financial institutions, such as banks and insurance companies, have unique balance sheet structures with large portfolios of financial instruments and specialized liabilities. In each case, the classification of balance sheet items must reflect the economic realities of the business and provide relevant information to users. This requires a deep understanding of the entity's activities, the terms and conditions of its contracts, and the expectations regarding future cash flows. Management must exercise professional judgment in making classification decisions and ensure that these are consistently applied and adequately disclosed in the financial statements. Transparency is a key element of effective balance sheet classification. Users of financial statements rely on clear and comprehensive disclosures to understand the basis for classification and any significant judgments or estimates involved. Accounting standards require entities to disclose their policies for determining current and non-current items, as well as any material uncertainties or changes in classification. This enables stakeholders to assess the reliability of the information presented and make informed decisions based on a complete understanding of the company's financial position. Technological advancements and the increasing complexity of business transactions have introduced new challenges and opportunities in balance sheet classification. The rise of digital assets, such as cryptocurrencies and tokenized securities, raises questions about their appropriate classification and measurement. Similarly, the growing use of complex financial instruments, such as derivatives and structured products, requires careful analysis to determine their current or non-current status. Entities must stay abreast of developments in accounting standards and best practices to ensure that their balance sheets accurately reflect the nature and timing of their assets and liabilities. The global nature of business also highlights the importance of harmonization in balance sheet classification. Multinational corporations must comply with different accounting frameworks in various jurisdictions, which may have subtle differences in classification criteria and disclosure requirements. Efforts to converge international accounting standards, such as the adoption of IFRS in many countries, have helped to promote consistency and comparability in financial reporting. However, local regulations and industry-specific guidance may still influence the classification of certain items, requiring careful attention to detail. Education and training play a vital role in promoting sound balance sheet classification practices. Accountants, financial analysts, auditors, and other professionals must develop a thorough understanding of the relevant standards and the underlying concepts. Continuous professional development is essential to keep pace with changes in accounting rules, emerging business trends, and evolving stakeholder expectations. By fostering a culture of excellence and integrity in financial reporting, organizations can enhance the quality and usefulness of their balance sheets. The significance of current and non-current classification extends beyond the preparation of financial statements. It also influences internal management processes, such as budgeting, forecasting, and performance evaluation. By distinguishing between short-term and long-term resources and obligations, management can allocate capital more efficiently, manage working capital effectively, and plan for future investments and financing needs. The insights gained from balance sheet analysis support strategic decision-making and help to ensure the sustainable growth and profitability of the business. In conclusion, the classification of assets and liabilities into current and non-current categories is a cornerstone of balance sheet reporting and financial analysis. It provides essential information about the timing and nature of a company's resources and obligations, supporting assessments of liquidity, solvency, and financial stability. The application of this classification requires a combination of technical knowledge, professional judgment, and transparent disclosure. As the business environment continues to evolve, the principles of balance sheet classification will remain central to the effective communication of financial information and the achievement of organizational objectives.